Hello and welcome to this special report at XM.com. I'm Maria Pashurthis, and joining me is investment analyst Christina Parthenidu. We'll be discussing U.S. stocks and the outlook for this year. So Christina, we're at the start of 2020, and so far things seem to be going well for the U.S. stock market, which opened with fresh record highs this month and after a stellar performance with low volatility in 2019. Do you think U.S. stocks will remain the best place for investments later this year?
Well, yes, I'm optimistic that 2020 could be another decent year for the U.S. stock market, but that doesn't mean that it won't be a challenging one. U.S. consumption, which controls more than 70% of the U.S. economy, is still a robust spot. The unemployment rate is almost at 50-year lows, and wage growth is rising at decade highs and above inflation, while corporate earnings are expected to be positive overall this year. So all these are expected to support demand for U.S. stocks. However, we shouldn't forget that trade risks with China and Europe are still lingering in the background, and the U.S. manufacturing sector is still in contraction. A phase 1 deal was signed yesterday, but more work needs to be done in the phase 2 of negotiations, which include more tougher topics such as discussions on technology and cybersecurity. So while some improvement in the data is expected earlier this year, conditions could deteriorate if tensions re-escalate, driving stocks in the industrial and energy sector lower. At this point, we would also be very interested to see how the Fed will react, whether it will keep interest rates steady as it has promised in 2019 or continue to cut interest rates.
I see. Now, regarding U.S. elections, do you think there'll be a headache for Wall Street?
Well, there are different kind of scenarios. Re-election of President Trump will be the most friendly outcome for the U.S. stocks if Republicans hold a majority in the Senate or gain full control of the Congress. On the other hand, a victory or a rising support for a Democrat, which will be more evident early in March when primary elections takes place in larger states, could pressure somewhat the U.S. stocks. Because of Democrats' preferences of higher corporate rates, but not as high as they were before. Otherwise, if Democrats remain divided and they fail to gain full control of the Congress, then political uncertainty may bring a steeper downside in Wall Street. Nevertheless, looking at historical data, U.S. stocks tend to rally after elections most of the time. So there is a large probability that they will do the same after November 3rd.
And finally, looking at the S&P 500 index, there's a rising impression that the rally is overvalued and a trend reversal is possible. What's your outlook for this year?
Well, indeed, if we look at the U.S. stock market cap to GDP ratio, this is above 200%, which is a level surpassed in previous recessions. And if we look at the S&P 500 dividend yields, these are slightly above the 10-year and 30-year Treasury yields, which make government bonds slightly more attractive. However, if we consider volatility, Treasury yield, U.S. stocks were more stable than Treasury yields, and that has likely kept buying interest in U.S. stocks. Now, from a technical perspective, the S&P 500 is indeed overbought, but has yet to show signs of trend reversal, meaning that any downside correction may not disturb the upside direction of the market, unless, of course, the price falls below the 3,000 level.
Christina, thanks so much for joining me, and thanks for watching at XM.com.